Hi, thank you for being here today to learn more about the CARES Act and how it will impact retirement savings. We want you to know that Sapers and Wallach's team are here thinking of you, and as such, we want to offer an overview of how this sweeping legislation will impact retirement savings plans. As things continue to develop, we will be here if you have any questions, concerns, or need guidance in understanding and navigating this new bill. With that, let's begin. Today's presentation is going to cover the following topics: the CARES Act, withdrawals, loans, required minimum distributions, additional considerations, and then of course our contact information. Let's dig a little farther. After going from the Senate to the U.S. House of Representatives, President Trump signed the CARES Act, which stands for Coronavirus Aid, Relief, and Economic Security Act, into law on Friday, March 27th. This monumental economic stimulus package is aimed at softening the financial impact of the global coronavirus crisis. This represents the third phase of legislation intended to help families and companies affected by the COVID-19 outbreak, and it will provide over $2 trillion in aid, which is intended to speed relief across the American economy. There are 5 main groups that would see the widest reaching impacts, which are individuals, small and large businesses, public health, and education. While there are other groups who are impacted by this legislation, today we're going to focus on the provisions that have been written into law that will support retirement plans and participants. So let's take a look. There are several provisions associated with retirement plans to consider, so let's start with withdrawals. The CARES Act allows qualified retirement plans to provide a special distribution option to individuals who are impacted by COVID-19. So a qualified individual may receive a coronavirus-related distribution, or it's also called the CARES Act distribution, of up to $100,000 at any time during the calendar year of 2020. This may include distributions made prior to the passing of the CARES Act. When it comes to penalties, the CARES Act waived this for participants who take a coronavirus-related withdrawal prior to age 59 and a half and don't roll the money into another qualified plan. The CARES Act also allows participants to waive the normally mandatory 20% federal tax withholding from the coronavirus-related withdrawals. Note, the participant may still be required to pay taxes on their distribution, and some states may require withholding. However, no federal taxes will be withheld from the distribution. A plan participant may, if they choose to, repay the coronavirus-related withdrawal to the plan over a 3-year period. Now, participants may choose to spread the withdrawal tax liability over a 3-year period rather than carrying the entire tax burden in 2020. The repayment won't be counted against their 2020 IRS contribution limits of $19,500 or $26,000 if you are 50 or older. If a participant repays the withdrawal amount to the plan, an amended personal tax return can be filed to refund any taxes previously paid on the repaid portion of that withdrawal. The CARES Act distributions can be funded from the participant's entire vested balance under the plan. So now that we've talked about withdrawals, let's take a closer look at loans and retirement plans and how they will be affected. The CARES Act allows qualified retirement plans to provide a special loan option and makes changes to the repayment of loans to individuals who are affected by COVID-19. The CARES Act provides that for loans taken during a 180-day period from March 27th through September 23rd of 2020, that the maximum loan amount increases to the lesser of $100,000 or 100% of the participant's vested balance. Now, previously, that limit was the lesser of $50,000 or 100% of the participant's vested balance. Lastly, the CARES Act also allows for the participant to defer scheduled repayments that are owed between now and December 31st, 2020 for 1 year. Now, if a participant does delay the repayment, The loan will be re-amortized with interest accruing during the deferral of payment. So next up, let's discuss the impact on RMDs, or required minimum distributions. The CARES Act allows plan participants who are over the age of 70 and a half and must take RMDs, or required minimum distributions, from their retirement plans and IRAs, including inherited IRAs, to waive the distribution for 2020. So any participants with an RMD beginning date of April 1st, 2020 won't be required to take their RMDs. And likewise, any participants with an RMD due on December 31st, 2020 will not be required to take their RMDs. The special rollover rule states that if a participant chooses, they may roll over their 2020 RMD to an IRA or other eligible retirement plan. So normally RMD payments are not rollover eligible. So this is a new provision under this legislation. So one last thing you want to think about: Roth conversion of your rollover RMD could be a great strategy to convert taxable savings into future tax-free distributions. Schedule some time with a member of your Sapers and Wallach team to find out if this is a strategy that's right for you. So that concludes our summary of the CARES Act. If you have any questions on the provisions of the CARES Act, please don't hesitate to contact a member of your Sapers and Wallach team. You can email us at solutions@sapers-wallach.com or by phone at 617-225-2600. Thank you for listening today. We are grateful that you are part of our Sapers and Wallach family. And if there is anything that you need, please don't hesitate to reach out. We're here for you. Be well, stay healthy, and we'll talk to you again soon.